last week's CPI-induced market rally gave investors hope that fears over prolonged Fed tightening were overdone. In the aftermath, we also got consumer sentiment data from the University of Michigan, which came in much better than expected. RBC says the release prompted them to revisit the relationship between consumer sentiment and stock market performance over time. So what exactly is that? Let's get back to Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Okay, so tell us about this correlation that you see.
Yeah, so, we do our weekly. It comes out on Mondays, and we're always trying to look for interesting things to talk about, whether it's questions from clients, things in the economic data, just, pertinent things. And I was really struck, by this big surprise on the consumer confidence or sentiment data on Friday. And I just, pulled out this chart that we have that just looks at year-over-year stock prices against consumer sentiment. And guess what? They've been moving pretty much in lockstep, especially if you look at the Russell 2000 over the last couple years. And I've been getting an earful about home builders recently. I think there's still just a lot of people that can't believe that part of the market's been as strong as it has. To me, it's just been sort of mimicking what we're seeing in the small cap space. But, I just sort of looked at this chart and kind of going back to the discussion we had earlier. We basically priced in a recession in terms of the percentage decline in the S&P last October. We actually did it on a small, large relative basis. We baked in a massive hit to the ISM in the small cap space last summer. So I can see in a few different ways pricing was consistent with a recession. Well, guess what? This consumer sentiment chart tells you it may not have been a recession last year, but consumers in this survey certainly felt as bad as they tend to feel in one. And guess what? The stock market is run by human beings. Yes, we have machines, but there are, human beings that are pulling those machines as well. And, I think sometimes on Wall Street we overanalyze things. We try to get too cute with our analysis. I think the simple answer to what's going on in the market is this year, this is a recovery trade. It smells like a recovery trade. The extent to which people hate it and have missed it makes it feel like a recovery trade to me. Every move off a recession low I have ever been a part of has felt like this. I've heard the same things over and over again. And that consumer confidence data just, sort of made it all hit home for me. We're just recovering. We just priced it in early. It's not a big deal. Move on and enjoy the party.
Yeah, on a related note, it's really interesting. We talked to Kyla Scanlon last week, who coined the term vibe session, where you feel terrible, but the data looks good, which is kind of where we were last year. And she said things are maybe starting to improve out of it. Consumer confidence would be an indicator for that. So could we be in a weird position 6 months from now where people feel okay, but the unemployment rate has gone up, for example?
Right, and I think it's a question, right, of how bad those indicators get. We talked about 1945 earlier. The unemployment rate only went up to the low fours. Well, that's what forecasters are anticipating this time around as well. So a bit of normalization in the labor market. Yes, some job losses, which are unfortunate, especially for those who they affect, but nothing, that's sort of terrible or as bad as what we've lived through in recent history. And I just think we forget sometimes that consumers have the ability, investors have the ability to sort of sense the big picture. And I think that's what's going on here. I also talk a lot about in a recession, there's kind of a snowball effect. And I'm not an economist. I'm sure all the economists around the street are going to cringe. But there's this whole thing of, well, we're heading into a recession, so companies scale back, and then consumers get freaked and they scale back. And I do think that the labor shortage is causing companies to not overreact. They're still talking in their earnings calls about this being a short, shallow recession, so they don't want to over-prepare for that. They want to be ready for the upside, but that cascades down to consumers as well. So yes, they're going to be a little more careful, but they're not going to freak out. They're not going to panic, and I think that's what we're all seeing.
Really interesting.